Your dozen indicators create a chaotic mess, a symphony of noise where you hear only isolated instruments, a violin here, a drum there, but never the cohesive music of the market itself. This paralysis stems from information overload, a condition where you are data-rich but wisdom-poor, frozen by contradictory signals from books and commentators when the moment to act arrives. The true obstacle separating the amateur from the professional is the failure to synthesize. A professional trader weaves essential threads into a coherent story, understanding that the market narrates human emotion through price and volume, driven by greed and fear. Without synthesis, you are merely guessing, acting on isolated evidence while missing the full context, which is why trades that seem perfect in isolation often lead to swift losses. The indicator was right, but the location was wrong, or the market's direction was against you. Begin by dismantling this complexity into 3 core components. First, assess the market structure before any trade. Determine the dominant trend on the higher time frame. The weekly or daily chart is your strategic map, revealing whether the path of least resistance is up, down, or sideways. In a clear uptrend of higher highs and higher lows, focus on buying opportunities. Shorting here is like swimming against a fierce current. In a downtrend, the path leads downward, and fighting it is akin to climbing a landslide. In a trading range where price moves sideways between boundaries, patience is key. This consolidation is a coiled spring, accumulating energy for the next major move, and the real opportunity lies in anticipating the breakout direction, not in chasing small bounces within the range. Once market structure is clear, the second component is location, your tactical zone of engagement. In an uptrend, not every price is a good buy. The amateur chases price out of excitement and fear of missing out, but the professional waits for a pullback to logical support, a level where buying pressure has historically overcome selling pressure. Buying at known support in an uptrust is a high probability action, entering where institutional demand likely reemerges. Think of it as the smart money waiting for a sale, acquiring inventory at a discount before the next upward move, rather than chasing prices higher. As a strategic trader, your primary task is to anticipate these critical junctures well in advance. These are not arbitrary chart patterns but zones of significant historical market activity, whether from a prior swing low, a major consolidation area, or a level that once witnessed a high volume of transactions. By patiently waiting for price to arrive at your pre-selected location, you fundamentally shift the dynamic, transitioning from an emotional reactor to a deliberate predator, calmly awaiting prey within a chosen ambush zone. The third and essential component is confirmation, the trigger that validates your hypothesis. After identifying the overall trend and selecting a high probability location, you must observe the market itself, confirming your analysis through specific price and volume action, revealing the footprints of large operators re-entering the market. For instance, in an uptrend that pulls back to key support, a professional does not buy immediately but waits for proof, such as a spring, where price briefly dips below support to trigger stop losses, then reverses sharply to close above it on surging volume, signaling a false breakdown and a liquidity grab. Alternatively, confirmation may come as a low-volume retest, indicating exhausted selling pressure and a clear path upward. This trigger is your final green light, aligning all 3 components, structure, location, and confirmation before committing capital. To synthesize this into a practical framework, consider a stock in a clear, healthy uptrend over several months, establishing our market structure and dictating a focus on buying opportunities. As price makes a new high and naturally pulls back, we avoid chasing or panicking, instead consulting our strategic map to identify a key support level, such as the peak of a prior consolidation range. This becomes our location, our zone of interest. We then enter a state of patient observation, awaiting our trigger. When price touches this support, the uninformed trader might buy hastily, but the strategic trader holds back. If price churns for days, then opens lower, plunges below support, and triggers panic selling, only to reverse forcefully by midday, closing near the day's high with significantly above average volume. We have our confirmation, a spring. With structure, location, and trigger aligned, we now possess a complete high probability setup. Execution follows, with a conservative entry just above the spring day's high to confirm upward momentum, and a critical stop loss placed below the spring's low, the point where our hypothesis is invalidated. Acting not as an enemy but as an insurance policy that preserves capital for future opportunities. To internalize these concepts, one must return to foundational wisdom, such as Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds, particularly in the annotated edition by Max Davidson, which offers timeless principles adapted for modern markets. This framework of structure, location, and trigger also guards against common psychological traps. First, it mitigates the fear of missing out. When a stock soars, you assess structure and location. Recognize no high probability entry exists and let it pass, understanding that capital preservation outweighs chasing gains. Second, it prevents catching a falling knife in a steep downtrend. You acknowledge structure and avoid long positions until evidence of accumulation and strength emerges, filtering out low probability emotional decisions. Conversely, in a downtrend, we seek high probability short selling locations, such as a key resistance level where broken support is retested from below. As price rallies to this level, the trapped amateur might see hope, but the strategic trader waits for confirmation, like a rejection at resistance, before acting, ensuring every move is disciplined, deliberate, and aligned with market reality. The strategic trader perceives this as a definitive opportunity. Price has arrived at our identified resistance level, and we now await confirmation of inherent weakness. What might that confirmation entail? Often it manifests as an upthrust, the precise mirror image of a spring. In this scenario, price briefly probes above resistance, enticing breakout buyers and triggering stop orders from existing short positions. Then, decisively, sellers overwhelm this buying, forcing a collapse that closes back below resistance on notably high volume. This action signals distribution. Large operators are leveraging the rally and the enthusiasm of breakout chasers to offload their holdings at favorable prices. This upthrust becomes our specific trigger. We now possess the complete structure, a prevailing downtrend, a key resistance level, and our confirmed trigger, the failed breakout on high volume. With this alignment, we can initiate a short position, placing a protective stop loss just above the high of the upthrust bar. If that level is breached, our thesis is invalidated, and we exit with a small, managed loss. This leads to the inevitable question: what occurs when the process fails? Imagine you follow it perfectly, a clear uptrend, a pullback to ideal support, a textbook spring confirmation, a defined entry and stop loss. Yet the market reverses, hits your stop, and you incur a loss. The amateur reacts with frustration and doubt, believing the system broken or the market rigged. The professional, however, reacts with indifference, understanding that no strategy possesses perfect accuracy. Losses are simply a cost of business, akin to a retailer accounting for unsold inventory. A well-synthesized strategy bakes risk management into its core. The stop loss is not an afterthought but a fundamental component of the initial plan. The professional knows their win rate may only be 50–60%, but their winning trades are, on average, significantly larger than their losses. This is positive expectancy. They may risk 1 unit on a trade but aim to gain 2, 3, or 4. Over a large series, this edge ensures profitability. Consequently, when a trade fails, the professional does not question the entire framework. They accept the loss documented in their journal and calmly await the next high probability setup. Their profitability stems not from any single trade but from the consistent application of their statistical edge over time. The true beauty of strategy synthesis lies in its adaptable, logical framework for interpreting the market's narrative. The specific triggers may vary: a spring, the absorption of supply at a key level, or a simple sign of strength, a powerful bar on high volume breaking resistance. The principles, however, remain constant. Align with the dominant trend, enter at a logical location, and wait for the market to show its hand before committing. This method cultivates an active, thinking participant rather than a passive signal follower. It trains you to ask the right questions, not, "What is this indicator telling me?" but, "What are large operators trying to achieve here? Where is the evidence of their activity?" You begin to see the chart not as random noise but as a strategic battleground. Trading ranges become periods of preparation where armies are amassed. Trends are the major campaigns. Springs and upthrusts are the tactical feints and skirmishes designed to mislead. By synthesizing these core elements, you elevate your perspective from that of a foot soldier in the chaos to a general surveying the entire battlefield from a vantage point of strategic clarity. Let us solidify this into a mental checklist, a pre-flight routine for every potential trade. First, what is the dominant structure on higher time frames? Am I aligned with the path of least resistance? Second, have I identified a historically significant support or resistance level as my location? Am I waiting for price to come to me, or am I chasing? Third, is there a clear, unambiguous confirmation signal, evidence of institutional sponsorship in price and volume that validates my thesis? Fourth, do I have a predefined entry, a stop loss that invalidates my idea, a logical target, and a precise knowledge of my risk per trade? If you cannot answer all 4 questions with absolute clarity, you do not have a trade, you have a gamble. You must step away and wait. The market offers near infinite opportunities, but your capital is finite. The purpose of a synthesized strategy is to protect that finite capital by deploying it only in those rare moments when the evidence is overwhelmingly in your favor. This is the practice of professional patience. The journey to consistent success is not about discovering a secret indicator. It is about constructing a robust, logical framework for decision-making. It is about understanding the timeless principles of supply and demand, human psychology, and risk management. It is about weaving these distinct concepts into a single, coherent strategy that fits your personality and time frame. The market speaks a clear language. The work lies not in predicting the future, but in learning to listen intently to the present. To become fluent in this language, the journey of learning and observation must be continuous.